What's better than earning money from a 9-to-5 job? It's earning money while you sleep, which is made possible if you start investing. You're listening to the Real Estate Investing Demystified with your very own dynamic duo, Ava Benesocky and August Biniaz. Tune in as we discuss everything real estate, both on the passive and active sides. We feature life-changing stories of today's real estate leaders that will help build your own roadmap to success. This is a show that will lead you to a diversified portfolio, a much bigger revenue, and a next-level venture that brings you a smooth cash flow. Let's get this episode started. Okay, welcome back to the show, everybody.
Welcome back to the show. Welcome back us to the show ourselves.
Yes.
And it's an exciting day. CPI report came out today, 5 in the morning. Ava is up. She's up before me almost every morning.
Yes.
Unless
Not almost every morning.
Okay, that's true. That's true.
Trying to get you up.
And she's like, "Isn't the CPI report out this morning?" I'm like, "Yes, it is." So we jumped online, and the CPI report. So inflation is down.
Yeah,
That's
exactly.
great.
My team was going to do a post on LinkedIn today.
Yes.
About inflation. I said, "Wait, hold a second. CPI report's coming up," and it actually went down. So.
Great. So yeah, and that matters greatly to real estate investors, special commercial real estate investors, because interest rates are a huge factor in the investments we make. And when inflation is high, the Fed, the central banks around the world, depending where the inflation is, and now it's global, they increase interest rates to combat inflation. So
what's your prediction for the next Fed rating?
I try to not to do these predictions, but I do them on LinkedIn here and there. I do polls usually, so I get the consensus. But it's what the experts are saying: 25 basis points. 25
basis points. All right.
So, but what's a bit concerning is that most experts are now saying that 2023 the rates will not be dropped by the Fed. They might stay where they're at. So we'll see. We'll see. They're saying it might be a drop in Q4, but
we'll keep you guys posted along the road.
Anyhow, getting back to our show, we have a special guest. He is extra special. I know sometimes I've used this word special. He is very special because he was our number one guest on our show ever. So we want to really appreciate him.
A couple years ago now,
I just went back and watched that, and I literally got like embarrassed, and I'm like, oh my God, what were we doing? What were we thinking? But that's the progress. You always want to get better. So really appreciate him coming back on the show. He's here to tell us about his journey, what he's been up to over the last couple years, and he's got a great conference, great event that yours truly, will be co-hosting the conference. So we're going to get the production of this show going and get it out there so you guys can watch it. So
yeah, we're gonna hear what it's all about, guys. It's called the Passive Investor Conference, and it's on from February 24th to the 26th. So Joseph is gonna share all the details on that.
Yes.
Coming up
so
shortly.
Maybe you can tell the viewers a quick bio of Joseph, and we can get right into it.
That's right. Okay, guys. Joseph Bramante. He is the CEO of TriArc Real Estate Partners. Now, his background was in engineering, working for global firms such as Exxon Mobil. Joseph started his real estate investing career after the GFC, and ever since he has found great success in multifamily investing. So we believe this interview with Joseph will bring great value to passive investors looking to learn more about the lucrative world of multifamily syndication. So welcome, Joseph. So happy to have you back on our show.
Hey guys, great to be back again, and it's great to see all the progress that you guys have made since my, being the inaugural, guest on your very first show. So it's awesome.
Thank you for
Let's dive into things, Joseph.
Yes.
If you could just start off by, tell everybody about your background and then your start in real estate, please.
Yeah. So, engineer, got the job at Exxon overseas, was there for, worked in some pretty crazy locations. Australia was my favorite, but then ended up spending the last 3 years of my career in Papua New Guinea, which is a little island just north of there, where I made, fairly sizable amount of money as an expat, unable to spend anything. I was, mid-20s, kind of kid making more money than I knew what to do with. And this was 2010. My manager was a rotator. I was full-time in that country, and he would rotate back home to Houston. And every time he'd come back to the job site, he seemed to own a new rental property. And so I didn't really know what was going on, but he was buying these houses for like 50 grand and then renting them for $600 a month. And I thought that was pretty cool. So I decided that I was initially going to go down that route and try and buy a whole bunch of those houses. And I wanted to buy like 80 houses at once with like I was trying to get a portfolio loan for $3 million and I had this beautiful spreadsheet and kept calling the banks to try and get this off the ground. And they kept telling me no for obvious reasons. But then one lender finally said, just go buy an 80-unit apartment complex. And so that was when the kind of light bulb went off in my head that I can, me, a normal person, can actually buy an apartment complex. So I did like any good engineer. I read some books, kind of taught myself the ins and outs. So I thought of the industry, and just like that, went and found the apartment complex and bought it sight unseen, still living in Papua New Guinea. And bought a small little 26-unit apartment complex, and kind of went through the ringer on that first deal. We did a 30,000 per door renovation on a 25,000 per door acquisition. So it was, back then those were crazy numbers, right? Now looking back on, I mean, we were knocked out of the park, but not without issues. We almost had to go bankrupt on the property because we had within 6 months of buying the property, our vacancy went down or went up to like 15%. We were negative cash flowing. The insurance that I'd bought was fraudulent, so we actually didn't have insurance. We were going into hurricane season, so that was a big deal. Then we found out we were trying to pull a permit for something, and the permit required an environmental, and I didn't get an environmental because they didn't tell you to do that in the book. So, and the lender didn't require it. So environmental came back hot for asbestos. So then I was really in the crapper, and then just the icing on the cake, Exxon decided to let me go around that time. So I was just like, no money coming in, negative cash flowing, asbestos, it was a terrible situation, but we turned the whole thing around, doubled our money on it. And ever since then, at that moment, I decided, this is what I want to do long-term. So fast forward, we continued. So through that process, I met my two partners, Carrie and Deborah, and we formed a company, TriArc Real Estate Partners, and we just started progressing, doing about a deal per year until recently, where we started doing multiple deals a year, and have built out the company to where today we're sitting at about 1,800 doors. We've got 5 executives at our company. We've got a full-time VP of acquisitions who's got similar experience to mine as far as been doing this for 12 years now. And came from a pretty big outfit currently they've got 30,000 doors. So he came from that big kind of syndication background. My two partners, Carrie and Deborah, each 30 years experience. And then in 2020, we brought on a construction company. So we bought a construction company, brought that on board so that we now can do not only our own renovations, but we can do renovations for others. And that's been a really good part of the business. That's kind of how we evolved. So we did 800 doors last year, and now we've transitioned to we got another 800 doors in ground up new development that we're breaking ground on this year. So we decided to make the switch in 2017, 2018 to start looking into new development and getting that skill set, because we really wanted to be able to complete the cycle. Everybody's seen the cycle of real estate. And there is a point on that cycle where acquisitions don't really make that much sense, and you start going into the development territory. And we didn't want to be sitting on our hands during that part of the cycle. So we decided to go ahead and get ready to make the transition and start building those skills. And it really kind of came on rather abruptly, where now we're pushing forward. And obviously we're using partners. We got a lead developer on 2 of the deals, and we're the lead developer on the 3rd deal. But really big believers in partnering with people who've got tons of experience, and just surrounding ourselves with great people like I've done from the beginning, from the partners that we've chosen to grow this company, because it's always been about subject matter expertise. It's not really, I never had relationships with any of these folks prior. It's always just been hey, recognize that you're really good at this, much better than I. Let's partner together and really form a team, a company that can be around for a very long time.
Awesome, Joseph. And there's a lot to break down there. And thank you for sharing your story with us. For the people that are listening, they probably want to learn a little bit more about going back to when you first started. Did you buy your first property with your own money, or did you syndicate it? Did you go to your family and friends? Did you have your own money saved up? Because you mentioned you were making really good money as a young guy. Or did you already know investors? Talk to us about that and how you got started, please.
Yeah, so the first deal was just me and one other colleague. So it was 50-50. And it was the first 100,000 I'd ever saved up. And anybody who saved up 100K, the first one knows how special it is. And it was, it was nice to be able to open my account and see all those zeros there. But it was only short-lived. And then I wired that money out like a few weeks later. And I remember the feeling in my stomach, that sickening feeling to my stomach, like, what have I done? Was still to this day, I can remember it. But yeah, it was my money, half mine, half his. I don't know what he was thinking, because I didn't know what else. I mean, I look back at the emails and whatnot, and like, we really didn't know what we were doing. We did get fortunate that the economy was very much in our favor, the market was in our favor. And while we did read the books and we felt like we had a pretty good understanding, compared to like what we know now to what we know then, I mean, it's just like, wow.
That's the thing, Joseph. I was going to say, a lot of people that read the books or even listen to podcasts and all this stuff, it looks like it could possibly be this simple thing, right? But once you actually get into it and do your first deal, my God, do you ever get, totally surprised, because there's just so much that goes on behind the scenes. It's not an easy thing to do. And just anybody just make sure you got some guidance.
Absolutely. And did you take any coaching programs or mentorship programs when you first started?
Yeah. So initially, no. And it wasn't until... So I got laid off on a Wednesday, and on a Thursday, I joined a real estate group and spent, at that time, it was like 10 grand to join. So I didn't waste any time feeling sorry for myself. And I knew that, I was in a bad spot. And so at that point, I needed to surround myself with more experts and more mentors. And so that's when I joined a real estate group. And that's when I got, that from ground floor up to 30,000 foot. So I already had this kind of like 30,000 foot education from the books, but I really needed somebody like, okay, ground floor, what do I do? And hold my hand and take me through this. And that's what I got with that group.
Maybe you can also discuss a bit about your background as an engineer and getting into real estate. Obviously, were you a petroleum engineer? Or I
was a civil engineer, and my passion was always around buildings and bridges. I always thought that I would design or engineer a bridge or a building one day, because they're fascinating. They're huge buildings. They're around forever. You're changing the cityscape, and you get to have a real impact on the society. And so that was kind of always my interest. And then the year I graduated, just coincidentally, Exxon and Chevron came to the career day, and they interviewed me, and they offered me a substantial amount of money, more than what the consulting firms are offering. So I decided to kind of go that route and go oil and gas. And I figured, worst case scenario, if it doesn't work out, I'll go back to being an engineer and design things again. But that was kind of how I went oil and gas. And I always tell people at Exxon, I got my MBA at Exxon, although now I'm graduating from Rice, getting my MBA in May. So I did officially get an MBA, but at Exxon, they do teach you a lot of the fundamentals of profitability, underwriting, forecasting, stuff like that. And for them, I was managing $1 billion in scope over on this project, and it was like 150 different contractors were managing. So it was a mess to take care of all that. But we learned a lot.
For sure. And the connection I wanted to make was about efficiency. So these large companies and corporations, they're very efficient, especially in the petroleum business. Do you see the syndication world, or the real estate private equity, as I like to call it, is it an efficient business, or is it inefficient or semi-efficient? What would you rate it?
Well, I say it depends on the person, really, more so than the industry. It's hard to say the industry as a whole, because it's really just kind of company by company. A lot of what we see. So first of all, Exxon is a project management business. They're really not oil and gas. They're the world's largest and number one project management company.
Okay.
And we just manage. All we do is, like, other people would actually build it, and we're just managing the projects. And so you get a lot of really good skills from that. And transitioning back to single family or to multifamily syndication is that you see a lot of sponsors who maybe don't have backgrounds in project management, or have backgrounds, they're doctors or lawyers, they're whatever. Those skill sets aren't very transferable to syndication, because they're just, particularly on the doctors and lawyers, or the accountability aspect and managing people, you tend to see more issues with that versus somebody who does come from an engineering background. You will see more the project management side of things play out. And that's really what multifamily is about, is especially when you get into value adds. And it's one thing to, pencil this out on paper. That's gotten to be easy enough these days, but then the actual execution of it, that's where the project management abilities really come into play, because anybody can draw a picture on a piece of paper of what they would like to happen, but then actually executing on that is the real differentiating factor.
Absolutely, great point. And it's great that you touched on, people from different career backgrounds, such as doctors and lawyers, getting into the syndication space, the real estate private equity space, and some backgrounds and experiences might not bring great value. But what do doctors and lawyers and other groups with large fraternities or communities do bring into the space is leveraging that community for capital raising. So a lot of these individuals come in and are able to raise great amounts of capital. I know some physicians who've come over and raised hundreds of millions of dollars, and this is in some cases a public record. Talk to us about your experience in raising private capital, raising equity. Talk to us about that journey, that experience when you realize that, hey, if I want to scale and I want to be in this business long term, I'm going to need to be able to raise capital, and walk us through that if you may.
Yeah, no, absolutely. So being a part of that real estate group was a really kind of big leg up to raising capital, because you're just surrounded by investors. And so that's initially how I grew from, the first 4 years was just raising capital through the investor group, and had plenty of equity. And we were really just going at a more deliberate pace based on, I want to do a deal, I want to get some lessons learned, and I want to reincorporate those. Because for us, long term, it was really more about going more institutional, knowing that we're not going to stay at this syndication space for really too terribly long. The plan was to go more institutional. And so in order to do that, you've really got to do exceptional deals, because they're going to be looking at your track record and seeing how you perform. So we were very selective on the deals we chose. And just the raising capital was through either the real estate group or through just networking, organically meeting investors, and then also just partnering with some other capital raisers as well. So we did bring on folks who raised capital for some of our deals, and we brought on that way. So there's, when it comes to there are other groups that are just like masters at raising capital and doing giant marketing initiatives and all that. And that's not us, engineer, really good at numbers and technical side. And now we're starting to pivot to the marketing side, but didn't want to, build a big foundation, or didn't want to build a big company on a weak foundation. So we really focused on getting that technical expertise before we started doing the marketing efforts.
Tremendous. Do you personally chat with investors these days? Are you part of that journey that investors take to come and partner with you and your group?
Yeah, no, we're always talking to different investors. Right now it's a bit tough, obviously, with the market the way things are, but we are always having conversations, and those conversations are really just to kind of keep the dialogue going and staying fresh, and both recognizing that there's really not much going on except for, special deals like our development stuff.
Right on. Now, Joseph, I wanted to dive into, so 2010 or 2011, you bought your first multifamily. You guys were doing value add projects for the last few years, buying one a year. Now, when you switched to development, what was that like for your investors? How did they react to that, right? Because they were so used to you educating them on how they're going to build wealth passively by being part of a value add, which usually has a component of that cash flow and so forth. So what was that reaction like?
Yeah, well, value adds generally don't have the strongest cash flow in the first couple of years. So investors going into, especially in the ones that we were doing the big value adds. So our average value add, our top 3 value adds were about $30,000 per door. So we've never shied away from big rehabs, and in the Houston market, we had plenty of them to go after. So our investors were already conditioned for, big exits, not so much on the interim. And making the transition to new development was very similar. It's like, hey, there's no money in the interim, but you're gonna have a big exit, and you're gonna have the opportunity to now stay in that deal because it's brand new. So you're exiting from a stabilized deal, which has a greater market appeal. You're exiting from a new construction deal, which has a greater market appeal than, say, exiting from a 70s or 80s product that was just heavily renovated. I mean, they're nice, but you're not necessarily going to sell those to an institution or a private equity. You're going to try and sell those to another syndicator, and it just gets to be challenging, especially in today's age. I think, one of the things that we saw was that properties are continuing to age out, and your 60s vintage property is or your 70s vintage now was your 60s vintage a few years ago. So they're really getting tougher and tougher to make a sell. You're starting to see those properties have less market appeal whenever you go to trading them. So we wanted to start transitioning our portfolio to the newer construction stuff that would have more longevity with it.
What was the term usually for your multifamilies, and what's the term going to be for your development projects?
Our multifamily was 5, and our development is 3 years.
3 years.
So it's a quicker turnaround. You get better returns. You get a better average annual return, and it's just accepting that risk that, hey, you're not going to get anything, and we're basing these off of comps in the area. So it's, but I think a lot of investors are okay with it, especially because they know the shorter the time period, and they see other products around it, and you really do a lot more data on new development because you've really got to prove up those rents because you don't have a trailing 12 to build on. So, and that's also why we partnered with, so 2 of our deals are, one's a wrap, one's a podium. A wrap is where you got a structured parking and you wrap the buildings around it, and a podium is where you got the parking garage and you put the building on top of it. So very complicated structures to build, or more complicated than your traditional garden style, which most value add properties you see these days are. So for those 2, we've partnered with a group out of Dallas called Calterra. They've been building new development for as long as we've been doing acquisition, or maybe a little longer. And so you partner with these groups, and they do all the underwriting for you because, since everything on that pro forma is completely, created, versus on an existing acquisition, it's based on some actual numbers. Whereas here we're basing it off of comparables and nearby properties. So it is more of a gray area. But that said, the opportunity for outperformance is much greater on new development, which is one of the attractions. For us, I do a value add deal. I know that generally it's going to hit between a certain range IRR, but with new development, I can estimate, usually when we're doing those, we're estimating from the middle to the lower end range, but there's a much higher range of potential returns in the high 20% range that you just don't typically see in value add. And we don't advertise in development, but when you look at historicals, they all tend to hit around there, because it is hard to underwrite these to a degree. So because of the amount of conservatism that you end up putting, it suppresses a lot of those returns to what seems like a comparable return to an acquisition, but in reality and actual performance, the new development deals tend to perform much greater.
And then do you guys lease up your developments and then sell them off to the buyer?
Yeah, so we do the full lease up. My partner Deborah, she did exclusively new construction lease ups for most of her career. So we do the lease up and the stabilization, and then we'll offload them.
Got it. And I think I know where Ava was going with this, because one of the first deals that we acquired was a syndication deal. We purchased a newly built project in Orlando from a developer. But our value add was that the developer had recently built this project. They had brought the occupancy to 90% to sell it to us, and they just wanted to quickly bring the occupancy high, so the rents were below market. So as soon as we were purchasing, the value add was just going in and bringing the rents back to market, and that was the meat on the bones that was left for us from the builder developer. Is that a strategy that you guys utilize, where you're not trying to maximize and bring in the best possible tenants? You're just trying to bring the occupancy up so the asset is stabilized, and then the syndication group or institution can purchase it, and then they have a margin for value add? Or are you focusing on just having a perfectly stabilized asset and then hoping for an institution to purchase from you?
Yeah, I don't really know if that is, I really personally believe that's more of a story that's told by brokers than a strategy, because, from our experience, developer, we're not going to offer rents lower. What you will do is you're going to offer a big concession, which is a one-time concession to attract them in, and the rents may be a little bit lower than market, obviously, to, again, appeal to them, but you're not so far off market for example, like $100 delta off market, and they were talking $5-10 million in purchase price that you'd be giving up versus just holding it another year and letting it stabilize if you needed to. So, for us, we just don't see that, that developers are going to leave that much in the untapped rent. What you would see is a pretty high concession, but those burn off over time.
But the concern is that you're bringing so much product to the market. You're building it like, let's say 200 unit apartment community or 300 unit apartment community. Now for that sub market, that's a lot of supply coming into the market in such a short time, and that's why the idea is that the rents are below market to just be able to bring in. But it really depends. So what are the regions you're building anyway? So you must do feasibility studies to see that there is high demand for housing in that area that you're building.
Yeah, so two of the projects are in Houston. So one's in Garden Oaks, which is just north of the Heights area. It's one of our upcoming areas. We already own 3 properties in Garden Oaks that we are renovating, so we know the demand that we're seeing there. And there's also 3 other projects being built within a 1 mile radius of ours. So we know it's a growing market. And then the other property we're building, or the other market we're in, is it's on the light rail. It's in Houston, but it's just east of the Heights area. So it's an opportunity zone, gentrifying area. It's great because you go into these markets, these sub markets, and the first thing you see is a lot of flip homes starting to happen. You see houses getting torn down or houses getting renovated, and that's always the first sign of a renovation or of a gentrification of the sub market. And in this area, you can see exactly that. And this is both properties are sites that we've owned already. They're existing apartment complexes that we bought. The one in Garden Oaks, we bought exclusively to tear it down. It was buy it, don't touch it, don't spend another dollar on it, tear it down. We're going to build something on top. The one on the light rail, we bought that one in 2014. We did a renovation, and the goal there was to do a rehab just big enough to get us to this point where we can tear it down. And that's worked out well. The other property is outside of Houston, just outside the Richmond area, smaller town. And because there was less data out there, we ended up doing an actual survey. So we worked with the government there. They let us publish on their social media platforms. And we got about 1,000 residents there to respond. And of that, 238 were pre-qualified based on their income, based on the apartment they wanted and the rent they wanted to pay. And mind you, we're only building 232 units. So we were 100% qualified already for the project. Hasn't even broken ground yet. So we're really excited about that one. But that's how we got the data in these smaller markets where it is tough and you got to really work with the municipality there.
Awesome. Right. Quickly get a couple of predictions from you before we move and discuss the conference. We started a show with talking about CPI report. We've been in an increasing interest rate environment over the last few quarters. It's truly interesting what's been happening, and we've been on a bull market for such a long time since basically you started. What are your predictions over the next for this year 2023 when it comes to multifamily, when it comes to value add business model? You're switching to development, but what are your predictions when it comes to interest rates, when it comes to the market? Do you believe that are you from the school of thought that there's going to be syndication groups or other investment groups under the water because of not purchasing a rate cap or having to repurchase a new rate cap, or being the rates being so high that now they're in a negative cash flow situation? Give us your prediction for 2023, and we can go from there.
Yeah, well, a lot of these properties. I think a lot of the properties that were purchased in the last couple of years, the post-COVID properties, you're going to see those struggle the most. A lot of those bridge deals were done with debt funds. But I also think that, those debt funds weren't really equipped to service the properties or to deal with a kind of return of the assets. So you're going to see probably a lot of extend and pretend, where they're just going to extend or work with the lender or work with the sponsor there just to kick things down the road until something improves, just because they're not really equipped to manage a defeasance situation. But I am aware of several groups that are struggling now. You're starting to see CapEx dollars spent to service debt, which is not good, or to service operating expenses, which frees up money to then service debt. So you're starting to see people do stuff that buys them time. And the question is just how much time can you buy before things either improve or get so bad that you can't buy any more time. My predictions are, CPI is a great indicator. PCE is probably another one that we look at, your personal consumer expenditure. And we really need to get that one down to closer to 2%. And that's kind of what the Fed's looking at, is the PCE number. And, looking at the last time that the numbers were this high back in in the mid 80s, it took about 5 years for it to get down back to 2%. So this isn't going to be a short.
And the interest rates were up to 20% at that time. So yeah.
It's going to take a while. People think that it's just going to happen quickly and we'll be done. We're back to business. No, this is a long haul thing. So if you're struggling now, it's you're going to be struggling for a little while. And I think that's something to be mindful of. That this isn't going to correct itself. That said, though, there is a possibility. I mean, there's I was actually just led the presentation from Dr. Mark Dautzer. He's a former chief economist for A&M, and he gives a market update every year. And his presentation was really talking about, the Fed's got these two tools at their disposal. One is mortgage rates that they've figured out how to increase, and then obviously the other one is the Fed rate. And they're doing their best to slow down this inflation, and without derailing us, right? So there's like a 30% chance they're saying that it will derail us, and that there will be something's going to break. And if something breaks in the economy, then mortgage rates will drop back down to probably 2% or below. Everybody's going to refinance. You're going to see commercial real estate boom again, and it'll be back to the heyday. But there's probably a 70% chance that this is more of a drawn out, kind of slower burn.
Soft landing kind of idea.
Painful, maybe. I don't know about soft, but it's just going to be, a grind down. Cap rates are going to be going, he thinks that cap rates will probably stay in the 5 to 6% range. We're not going to see them get crazy low, but they're not going to go crazy high either. And then the other thing, the one, I guess, sort of good thing is that, every month we've got all these T-bills that are refinancing from 0% up to like 4%. And so that increase, if that continues to happen, and if it goes up to, another 2%, if it goes up to 6%, then that effectively could increase our spending on debt service by $600 billion, which is a substantial portion of the defense and all those things. So, Powell is really restricted, and that's why he's really trying to go fast before all these T-bills start refinancing and the government's own debt service starts to get out of hand. So I don't see and he doesn't see, and I'm just parroting what he said, that they don't see a quick reduction in rates, that this is going to be more prolonged. Also keep in mind that there's, if you look at the personal checking balances of private citizens, we're at all-time highs. I mean, it's just a gigantic, it's like $5 trillion or something like that in checking that people are just sitting on. And so the risk is that if they don't correctly address inflation and they do just a really quick patch and try to get back to business as normal, then people will start spending all this money that's in their bank accounts, and we'll be right back where we were.
Yeah. Oh, great. Thank you for that. Okay, great. Let's talk about the conference. So
Passive
tell us
Investor Conference. I'm looking forward to hearing more about this. February 24th to the 26th. What's it all about?
Yeah, and just quickly here is if you are a passive investor watching or listening to the show, looking to get into this lucrative business, you've heard about Joseph's journey and our journey. I'm sure you've heard it before, but we've always got a lot of our education through online sources, books, podcasts, YouTube, that's right. A lot of events. This conference is focused on passive investors, so a lot of great people coming and speaking. So yeah, Joseph, please go ahead.
Yeah, I mean, what you kind of alluded to there was a lot of the conferences that, the vast majority of them are really kind of a bit one-sided. They're really talking about how do you become a syndicator. They teach you the same basic, information about multifamily, but then it kind of really shifts to, okay, underwriting and like everything you need to know to be good at being an active investor. But from the passive investor side, you're really kind of left with, a half understanding of everything that goes on. So this course or this conference was really intended to do a couple of things. One was to provide the passive investors specific to multifamily with an understanding of how to kind of break down a deal and ultimately how to choose the best deals with the best sponsors and the best markets. So it gives you this, really secondary type of calculations you can do that, I had to really custom engineer and figure out a lot of this stuff for myself. Was, I know how to do it on my side, but if I didn't have access to the pro forma, how would I reverse engineer some of these things? And what can I determine just from the generic single page pro forma that a lot of syndicators put in their presentation? So this whole course is really about breaking down those investment packages, or conference, breaking down those investment packages and helping you choose the better deals to invest in, especially in today's market where things are really hairy and you're going to see a lot of syndicators really try to push the envelope and push things that they probably shouldn't push because they're just trying to get a deal done. And deals are really tough to get done right now in general with the current markets. The other thing that they're going to get exposure to is just all the other types of assets that are available to them. So from RV parks to mobile home to self-storage, industrial, cannabis. I mean, we've covered private equity is one of the, I'm actually getting in some private equity deals myself where you're like buying into or investing into small businesses. We got a speaker on franchises, investing in franchises, and all of these are from industry experts, and they've all been advised or the guidance they were given for their presentation was pretend your best friend has presented a deal to you and your particular expertise. What advice or counsel would you give them before making that investment? So it's really about giving the passive investor the tools they need to be a little bit dangerous when making investments in those other asset classes as well. So that's really what we're covering. We've also got a market update. So we've got Casey Conway. He's the chief economist for CCIM. He's going to be coming and giving a full hour-long presentation on the market and the forecast for the next year and years to come. And then we've also got Dr. Jam Papa. He's the leading physician on anti-aging and longevity. So he's got a clinic out in Costa Rica. So he's going to be talking about all the advances in stem cells and everything that's going on. And it's really fascinating stuff. So we're really trying to cover the full gambit of things that an investor would want or need to know for their investing career.
Yeah, and Ava can touch on this. A lot of times investors that get on calls with us, they're tired of the conventional investing. So just invest in the stock market, listen to what financial advisors say, and watch your portfolio go up and down very erratically. Whereas the alternative investment space gives you other options. The options are not only what institutions, large banks are pushing is, being able to invest with a syndication group. We talked about cannabis. You talked about, multiple asset classes that exist within the real estate sector. So, super exciting. This is the best of the best for alternative investments conference.
Yeah. We're gonna share the link as when we market this. So make sure you guys look out for that. And August, what is your topic about?
I'm going to be talking about BTR SFR, but I'm also going to be co-hosting.
Right on.
So,
that's really exciting, guys.
I'm co-hosting today.
Do I get a free ticket?
Yes, sure. We can talk about it.
Come on.
We can talk about it. I could work something in.
You got connections.
Yes.
Okay.
10% off.
10% off. Okay, perfect. Thank you. All right, guys, here we go. Let's go to the next.
Absolutely. Thanks so much for sharing all your wisdom
Joseph,
and your transparency. Really felt like I had a crash course when it came to your background and everything else, and also making the transition from syndication value add to ground up development. Thank you for that.
Yeah,
perfect.
Thank you, Joseph. All right, here we go, guys. 10 championship rounds to financial freedom. So Joseph, whatever comes top of mind, we're just gonna start.
And take your time. Take your time. Some of these questions might make you think. So go ahead. This is the opportunity for people to learn more about what goes on up there in your brain.
And who's...
Could be dangerous.
Yeah, here we go. All right, ready? Okay, first question is, who was the most influential person in your life?
That had to be my grandparents. I've had many people kind of mentor me throughout my career and my life. And they were the ones kind of in my mid-teens and up through my early 20s that really played a key role, and one even helped me get into college and helped me stay focused and giving me that kind of wisdom I need to not get distracted with all the little stuff going on around me. So yeah, definitely grandparents.
Maternal or paternal?
They were my adopted grandparents. So I got a really interesting background that got my blood family side, but then I was pseudo-adopted by a secondary family that kind of, they were really our babysitters growing up, but then we just got to be really close with them and started going to holidays and Christmases and Thanksgiving, and basically we became part of the family. And so I was actually so my maternal grandparents. Yeah.
Oh, you're a pretty sophisticated guy, so man, I wish I was adopted to get a little bit more sophistication in me.
Yes, there you go. All right, Joseph, what is the number one book you'd recommend?
The number one book was Dave Lindahl's Multifamily Millions. That was the book that really got me started. And the secondary book I would say would be mine, coming out this summer. So I got a book exclusively on passive investing from the eyes of a passive investor, and it teaches a lot of almost everything that's in the conference, except maybe a little bit more detail. And something you can, the plan for that book is that it's something that you'll keep on your desk whenever you're reviewing investment opportunities.
Right on. Okay, perfect. Next question. If you had to travel back in time, what advice would you give your younger self?
Geez, how far back are we going? So if I were going back in time, I would have not wasted so much money on stupid stuff and invested more. There was a period right when I got laid off where I was sitting on a sizable amount of money and I wasn't budgeting myself well and had spent a lot of money just on going out, enjoying myself. And it's funny how you can really blow money when you're not paying attention. So just having and after that point, I learned how to budget and live more like a true entrepreneur than just spending on whatever I wanted. So that, and then, I would have probably bought a whole bunch of crypto and then sold it at the right time.
Same. Those are two things I would tell myself. Yeah. They look awesome.
Nice. Okay. What's the best investment you've ever made?
The best investment would be my first property. And that was just, timing and everything. And it was hell, like going through it. But now, I mean, we made a 2x return on when we first bought it. So we made a 2x return after 3 years of ownership. And now we're about to tear it down and build 100,000 square feet of self-storage, and should make another 2 to 3x return on that. So it's really kind of grown to be, actually it'll be a bit more than that, because our original investment was only $250K. And so now we're going to be making millions of profit on it. So it was, yeah, but that was more so a factor of timing in the market. Things were very cheap back then.
Yes. Now, what's the worst investment you've ever made, and what lessons did you learn from it?
Yeah, so the worst investment ever made, I don't want to say worst, but it was a tough one that was really due to market. It wasn't really anything in our control. We bought a deal right before COVID, and that deal, obviously COVID completely messed up everything and caused a lot of issues with the evictions and supply chain and all that. And this was our largest renovation. We're doing a 37,000 per door renovation on this property. So a huge $8 million rehab. And just really messed up all our plans and messed things up. So that was we're still going to exit and do very well, but we should have done much better than what we're going to do.
Right. Okay.
Tremendous.
All right. Next question. How much would you need in the bank to retire today? What's your number?
I don't know. Like, what do you do when you retire? That's the whole point. Like, I've taken the long vacations, and after, I've traveled Europe for 3 months and was anxious to get back and work. And but to go through with it, maybe 100 million, I think would be good. And then from there, you got plenty of money for family planning in the future, and then also for passing down to the heirs and all that. And then for investing, I think that's kind of that would be okay. But even still, I would still be doing the same thing I'm doing now. I'd still be buying and building properties. So I don't plan on, just because I got a bunch of money, I don't plan on not doing this anymore.
Don't plan on retiring. I love that.
Yeah.
Awesome. Okay. If you could have dinner with someone dead or alive, who would it be?
It's an interesting one. I haven't really thought about that one. I like Ray Dalio. I think he's a really smart guy. So I'd probably want to meet with him. But then historically, I'd want to probably meet with Roosevelt or one of the presidents, just like one of the early presidents, like Lincoln and all them, just to understand, in our minds and all our history books, we're told this certain story, and it would just be cool to see like how they really were,
Right
how
on.
much propaganda has been like kind of pushed along through the years, and you tell a story and it gets retold, and then versus like, okay, well, how much, were you really this person? You read the Bill of Rights and all that, and you're just like, wow, did you guys really think all this stuff like 200 years later or whatever? Did y'all really think all this? So I'd be curious to see like what they knew.
Yeah.
What their foresight was.
It's really cool. I like that. Okay. If you weren't doing what you're doing today, what would you be doing now?
If multifamily hadn't worked out for me, I probably would have been back at oil and gas, maybe for Shell or Chevron.
Okay.
So that's probably, I'd be doing project management for Shell or Chevron, most likely.
All right, Joseph, book smarts or street smarts?
Book smarts.
Book smarts. Okay. Right on.
Yeah. I mean, you learn a lot of street smarts along the way, but the book smarts allow you to fast track a lot of that stuff. So I think street smarts you can pick up as you go, but the book smarts, you can't just pick that up on the fly. Like you've got to put it in the time and read it and learn it and apply it. And really books are just a combination of somebody's street smarts that they wrote down. And so they're really similar.
Cool. Okay. That's really cool. Last question. If you had $1 million cash and you had to make one investment today, what would it be?
Probably into my deal that we're about to break ground on. So that's what I would do. It's in a emerging market, ground up. I think, there's, emerging markets are really like the holy grail for development. And so finding one and getting into one, the returns and potential are really much greater than what you can underwrite to.
So you all heard it. If Joseph had $1 million, he'd be investing in a ground up development project, multifamily in Houston, right? Or Houston area?
Just outside of Houston, yeah.
Awesome. Thanks, man. This is awesome. Really appreciate you being here today. Again, we got our first guest that is revisited again. So it was a great feeling for us too.
Yeah, it was really great, Joseph. Just quickly let everybody know, what's the best way that they can reach you?
Yeah, so the best way would be let's just connect on LinkedIn. You can just my name at LinkedIn, or you can send me an email, jbramante@triarcrep.com. Those are the best ways. And then our website, triarcrep.com. And then there's a button on the middle of the page to become an investor if you want to learn more about us and connect.
Right on. Thanks for being here today. I
Likewise.
look forward to the conference.
Absolutely.
Yes. Likewise. Look forward to seeing you guys there.
Thank you for joining us for this episode. We hope this conversation enlightened you on how to win big in this highly profitable and risk-averse space. Get on your feet and embrace this world that offers so many opportunities just waiting for you out there. Continue your journey to becoming a savvy real estate expert by subscribing to the show at cpicapital.ca. Don't forget to leave a positive rating and share with your friends. See you on the next one.